presentation. This is brought to you by Team Rocket, and we hope you enjoy the full length of this presentation, which will be around 30 to 40 minutes. The people in this presentation is me, myself, Tausif, Yassine, Lee, Felicia, and Dominique. We put a lot of effort into it, and if you have any questions, please wait till the end, or we can pause throughout the video and you can ask the questions. Also, some credit to Yassine, who edited the whole video together. He uploaded it, constructed it, put the transitions and everything. So if everyone can give him a round of applause, we'll get right into it. See you in the video. Good morning, everyone.
Morning.
So how's the markets, everyone?
Not so good, it's no profit.
It's not looking good today.
You do know the basics, right?
Yeah, of course. You buy low and sell high, right?
Well, actually, no, you don't. You buy high and you sell low.
What?
Individually, we traded throughout the week, and the presentation that we are doing now will discuss the main key indicators that we've used to carry out trading throughout our trading simulation exercise last week. We'll be discussing various news events that's been happening over the last 2 to 4 weeks, as well as the weekly news that has happened last week, which influenced our decisions to go long or to go short.
You finally turn out some money?
No. First, you must be able to make a loss before you're able to make a profit. And these are the 4 key principles that I've used amongst the week that we've traded. Number 1, you never try to predict the markets. With the Forex market, with binary options, you must be able to move with the markets to be able to predict the movements, whether it's going to go long or short, would be going against what the market is showing. No single trader can have any particular piece of inside information on the direction or the shift. Hello guys, before we get right into the main brunt of the presentation, I'm going to very quickly go over the core principles of trading. So as I said, you shift with the markets. Now, going into the inner minds of my head, I'm going to quickly go over the 4 points. So, going back to point number 1, you never predict the movement of the markets. Point 1 and 2 go in tandem with one another. Prediction of the markets usually leads to conflict of analysis, and that could create issues for the trader. So in most cases, when you make a trade, you'd make an assessment based on the direction that the market is moving towards. What will help you in assessing the movement of the market would be various news indicators. And of course the measurements as well, like the RSI and Bollinger Bands, which I'm going to go into a little more detail. Both indicators, RSI and the Bollinger Bands, are ones that I've been using as well for my trades, and I believe that they helped a lot in making as much money as possible. My third point is to make multiple orders. Making multiple orders, especially during a news announcement, helps and goes a long way in securing even more profits and pips. So during a news announcement, say a US PPI claims or tax rebate, you would make 4 orders, a short and a couple long, if it was to spike, because usually during the initial stages of the announcement, it would drop a little bit, and then you would skyrocket up, but you'd make your orders throughout. Now we go back to the video. So going back to the US announcement, if there was an announcement that was to be made, if I show you on the graph.
Tausif, I just can't do it. I need to make money.
Right.
Please help.
So as I was saying before, when you move with the markets and you use indicators to assist you, remember when I was talking about you move with the markets? So you would get the news events up, and if I were to show you an example, right? Like I said before, if say an announcement was to appear, say here, right, something to do with US interest rates, you would want to probably go short, because the forecast would tell you, okay, the trading indicator is going to go down between the euro to US dollar.
I see.
So yeah, you go short. But another strategy that I was going to discuss with you guys was to make multiple orders. So usually when a news announcement appears, if it's a good news forecast, it would go up, right? The currency pair would show signs of some form of appreciation. And based on that, you'd make your order. But in the initial moments of the news announcement, the pair usually has a slight dip, and in that moment, you would make a small, quick, short order where you'd bank a couple of pips, and based on the forecast, which is usually positive for most cases, you would go long and make a couple of orders as the pairing goes down. So if I was to use the graph as an example, you would have gone short here, for instance. This is not a good example, but just to show you, if you had gone short here, you would have made a couple pips, and hypothetically, if the graph was to show an increase afterwards, you would have gone long at the lowest point, which is where you would use the indicators, which I'm going to show you right now, both the Bollinger Bands and the RSI. Based on those, you would then make your order. So right here, at the lowest point of the RSI, which indicates the period where there's a lot being sold, oversold, you would then make an informed decision saying, it's going to go back up, so I will buy it at that point. It's gone below the 30 threshold, so then you know that there will come a point, at the lowest point, you can go long, and you'd be able to maximize the level of pips you make. Though when I was talking about multiple orders, you'd make a couple of orders as it goes down. So one would be at the lowest point, whereas number two, maybe you'd make it one here and another here. That way, it's kind of like hedging the number of pips that you are trying to attain.
Sir Tassif,
Yep, Alicia?
what exactly does RSI mean?
Right. So the RSI, Alicia, it compares the recent gains to the recent losses. It acts as a momentum indicator. So if you look on the graph right here, you can see around at the bottom point here that a lot of the euro to the dollar is being heavily oversold. This indicates that a lot of investors, with time lag of course, because this isn't actually an accurate reflection of the number of currency pairs being sold and bought in the market, but nonetheless, we can still use it to judge and assess the potential movement in the currency pair. So if I were to say an example right here, at this point when you start seeing the line go below the line, you can then say, right, the currency pair is going to start to decline at that point. So in your mind, you would immediately have a breaking point thinking, yes, I'm going to go short at that point, and I'm going to put a put profit and put loss order, and I should secure this number of pips. Obviously at the lowest point, so around here, it's indicating that the number of oversold of the currency pair euro to dollar is going to start going back up. At that point, you would then go long, where you'd then be able to secure even more pips. That goes in line with what I was saying earlier about making multiple orders. So you would make a few orders as it goes down, and when it goes back up, you'd make a long. Obviously, you take this with a pinch of salt. Like I said, you can never accurately predict the markets. And in this case, though it shows a slight increase, it generally stays below. But obviously, like with everything that comes down must always come up. And the RSI is very useful in assessing the overall momentum of the two pairings.
Wait, I understand RSI, but what's the Bollinger Bands all about?
Dominique, as usual, not paying attention to class, eh? Well, this is why, guys, we made a massive loss in the last week due to Dominique's predictions. Like I said, you never follow predictions. But anyway, Bollinger Bands, Dominique. I'll go into a little bit of detail on that. So you can see there's three lines, yes? They represent the standard deviation from the mean. So as the lines widen, that means there's more volatility between the currency pairs, and the closer the lines are, the less volatility they are. You can use this to help assess how much of a fluctuation there is. Based on that, you can make another decision, an informed decision. Once again, you never predict, and we'd use these two indicators in tandem with one another, and that's why the RSI and the Bollinger Bands are very useful to be used to make an informed decision. Right, so the last most important point is to buy higher and to sell lower.
But Mr. Tausif, I thought the saying was the other way around. Buy low and sell high.
Well, Lee, that's a very good question. And I will answer your question with an equally imposing answer. So, if you look at the graph, what you said is to buy low, sell high. The idea with that is when the price goes down, you would buy it, right? And when it goes up, you would sell it. But in the case of any market, whether it's forex, stocks, shares, whatever the case, a key principle to remember is to buy high, sell low. And I'm going to explain to you why. If you look at the graph right here, so you see the trend line is moving downwards. During its shift downwards, based on the indicators that you have up, you would do what?
So surely, at this point, we would sell our currency because the RSI is below 30. That's what you said earlier on.
Very good, Lee. You're right. You would sell. as you said correctly, based on the RSI, it's gone below the 30 threshold, indicating that a lot is being sold. So based on your logic and my logic, by selling, you're moving with the markets. So what are you doing? You're selling as it's going down. So going in line with my philosophy of buying high, selling low. Do you understand now?
Oh, okay. Yeah, I understand now. Yeah, that was a good explanation. I like it.
Right, so these are the basic core principles, but what about the market itself?
Oh, right. Yassine, I didn't see you there. Good question. Well, the market is the market, and it's affected by various policy measures and government practices. It's important to understand general market sentiment, meaning what the overall attitude traders have towards the market. So what does this mean? It basically means the general opinion of the masses. That's what trader sentiment means. So when I said earlier about you being unable to predict the market movements, that's true, you can't. But the market is influenced by the majority of traders that are undergoing transactions. So, like I said, trading opinion, market sentiment are very crucial in assessing market conditions. And I'm going to quickly elaborate on that. Crowd psychology on the whole can have a huge impact on general trading indices, more so in the currency market than the general markets, stock markets in general. A lot of the decisions and the movements in the market is influenced by us. The majority of movements are controlled by various policies that are implemented, like I was talking about earlier, of the US tax rebates and inflation and interest rates. These would all be reflected in movements in the currency pairs through the decisions made by the majority of the traders as well as the government institutions. So this would be as a result of the news, but also due to market sentiment. So now I hope you guys have a better understanding. Right. So these are the core principles of trading, guys.
Hi there guys, I'd just like to welcome you to my presentation on trading. This is a quick overview of what Tausif taught me about 3 or 4 weeks ago. So I hope you enjoy what I have to say and take some good information from it as well. Okay, so in this section I will cover the world financial markets. Now what this will include is an overview of the financial markets to the 4 weeks prior to the trading simulation. So this will cover the euro and US dollar currency pairing. I will also provide an explanation as to why the markets behaved as they did. And to do this, I will focus on various news stories that happened throughout and try to link these to how the currency fared. So here we have a graph which shows the euro US dollar currency pairing. And the graph begins around the 9th of January and it finishes towards the February the 18th. I will begin by focusing on each week, week 1, week 2, week 3 and week 4, and then the trading simulation week will be carried out by Dominique. So first of all, we just want to look at the graph. We can see that it is divided into 2 sections. We can see here and here. Each section is divided by resistance bands. So we can see from week 1 to pretty much week 3 that the currency pairing stays within this resistance band. And then towards the end of week 3 it breaks through and then it creates a new resistance band. So here we have a graph which shows the euro to dollar currency pairing. It's a 6 weeks graph from now. We can see that there's divided into 5-week sections. Week 1 to 4 I will cover, and then the trading simulation week will be covered by Dominique. So first of all, I'm just going to take you through a quick analysis of what this graph is showing. So in the first 3 weeks, 1 to 3, we can see that the currency pairing is situated between these 2 resistance bands. But then as we get towards the end of week 3, the currency breaks through and starts a new resistance band pairing. We can also see that in week 1, towards the end of the week, there's a negative trend, and then week 2, there's a positive trend. And then this positive trend continues well into week 3 and almost into week 4, where it finishes. So I'll go through each week and describe the news events that allowed the graph to look like this. So week 1 was 18th to the 24th of January, and it opened at 1.0898 and closed at 1.798. So we can see from this graph of the week that it actually started off quite slowly. Now this is because there was a US bank holiday on this day, so all of the trading firms were closed, hence there was very little movement. We can see that towards the end of the week we begin on a negative trend. Now this is a result of the European ZEU statement of 22.7. Now what this refers to is an amalgamation of 350 economists and their view on the future of the European market. Now in this case they believe that it isn't performing as well and the future is looking bleak, so hence the decrease in the currency value. This was further backed up by the US monthly CPI, which was actually a negative 0.1%. This coincided with the European ZEW statement, and this is why we see a rather large negative trend in the graph. Okay, so now if we look at week 2, which was the 25th of January to the 31st, we opened at 1.0789 and closed at 1.0830. Now, as we can see from this graph, it's looking a lot more positive. It's growing from when we opened all the way to the end of the week when we see a high of 1.0966. Now, the main reason for this was that at the start of the week, the ECB President, Mario Draghi, he had a speech in which he was essentially trying to reassure investors about the credibility of the Eurozone. So he touched on the fact that interest rates were going to stay at the 0.05 level. The purpose of this was to essentially instill some confidence in the market because it's been rather shaky recently due to the migrant crisis as well as the recent developments regarding Britain's situation in the EU. Yeah. So as we can see, we get towards the end of the week, sort of January the 29th, and you can see that there is a rather large decrease in the value of the currency pairing. Now, one possible cause of this was the announcement of the US durable goods orders. What this is essentially is orders of durable goods from US consumers, and it's a good sign of how the economy is performing. The negative 5.1 value obviously suggests that the economy isn't at such a good level. So as we get to the end of the week 2, we can see that around the 29th of January there is a significant decrease in the currency value. Now, one main cause of this is the announcement of the US durable goods orders. What this is essentially a measure of new purchase orders placed with manufacturers for durable goods. It's a good indication of the performance of the economy, so hence the negative 5.1% value, obviously a sign that the economy isn't in such a great situation. Now, if we take a look into week 3, this was the 1st to the 7th of February, we opened at 1.0830 and closed at 1.1141. As we can see by the graph, there is a significant rise in the middle of the week, followed by a stable period towards the end, and I will get onto the reasons why in just a moment. So the week began with another European Central Bank announcement from President Mario Draghi, and it was kind of similar to the previous one where he was sort of reiterating that the European Union is still in a good place, and sort of the whole idea behind the speech was to maintain a positive market sentiment. So traders would still be encouraged to trade in the euro-dollar currency. Now, as we get to the middle of the week, we can see that there's a huge rise. Now, one main cause of this was the US non-farm employment rate. Now, what this essentially measures is the number of US citizens that aren't working in farm or government. So it's another good indicator of how the labour market and the overall economy is performing. The value was measured at 205k, which just type 12,000. Okay.
Good.
The value was measured at 205k, which was actually 12k above the forecast, which is excellent news. So hence the currency pairing actually rose because the market seemed to be in a good position. So at the start of the week, we had a US holiday. This meant that trading was at a minimum because the US trading firms were not at work that day. But as we can see throughout the week, it's very up and down. It's quite confusing. But this is due to the market sentiment. Now, this is regarding the Federal Reserve Chair, Janet Yellen. On the Wednesday, she had an announcement. And what this announcement covered was the fact that the future of the US interest rates, it's more than likely it's going to be heading into a negative interest rate. So the Federal Reserve Chair, Janet Yellen, she had an announcement where essentially she declared that the US interest rates are soon going to be heading into negative values. Now, what this means is that the US banks will have to pay a charge on their reserves of money that they have. The reason for this is so that the banks will be not forced but sort of enticed to lend more, and ultimately this will sort of push growth. The negative interest rates is to entice the banks to lend more, and this will hopefully create economic growth in the US economy. However, you can see that towards the end of the week, once the announcements have been made, obviously the lower interest rates isn't what the traders want to see. So this is why the currency was on the negative trend towards the end of the week, because the traders were offloading because the unclear future that the dollar is currently facing. Thank you for listening. Now I'm going to pass you over to Team Rocket News, who will take you through the trading simulation week.
Hello and welcome. I'm Dominique and this is my co-host.
Tausif.
And you're listening to
Team Rocket News. Now for a roundup of this week's news that has affected traders and their trading activity this week. We're also going to provide commentary on our own trades that we've made throughout this week based on the news. On to Dominique.
Thank you, Tausif. So, on Monday the 15th of February, European Central Bank President Mario Draghi gave a speech about quantitative easing and making the euro area more resilient. He stated the ECB are ready to do their part and that they would do whatever it would take. Usually during his speeches, there's a major volatility as traders attempt to decipher interest rates, and sure enough, with the announcement of more quantitative easing, the euro was pushed downwards at 1:30 p.m.
As Draghi started his speech, the single currency was trading around 0.9%, about 1.1148 to the US dollar. So now we're going to make a few comments on our own, on what I did for that particular date. On a personal trade, based on the ECB talk, I used a 15-minute graph, and around 20 minutes into the ECB presidential talk, the movements on the market spiked. There was no real consistency as movement was all over the place. So at around 14.23, I decided to go short at a price of 1.11728. I did this based mostly on the discussion itself, but also because my indicators showed that there would be quite a steep decline. As you can see, the RSI has gone below the 30 threshold. And I banked around 4.8 pips. So on Tuesday, the Zoo Economic Sentiment was released at around 1:30, and this is basically an amalgamation of the sentiments of approximately 350 economists and analysts regarding the economic future of Germany for the next 6 months. It's a leading indicator of economic health, and investors and analysts are highly informed by virtue of their job and changes in their sentiment. This can be quite useful as an indicator to the currency pair. So elaborating on my earlier point, this is basically a survey of around 275 German institutional investors and analysts. And Germany is quite important for the euro to dollar pairing, being they are quite a prominent member of the EU, as well as a massive user of the euro as in general. So as I was saying, it's around 275 German institutional investors and analysts which asked respondents to rate the relative 6-month economic outlook for Germany. And this is quite important as a measure of Germany's overall economic performance.
I'm now going to discuss our trading activity for Tuesday. So basically, we didn't initially trade when the news was released at 1:30, we waited for 2 hours and we decided to go long on the currency pair at 3.14 at a price of 1.1135. Upon seeing the forecast from the Forex factory, we assumed that there would be a shift in the trading indices. Using the Bollinger Bands, I noticed that there would be an inevitable rise as trading was close to reaching the overbought threshold of 30 on the RSI. I made an order early and made another purchase as soon as it hit the peak, the lowest peak. As predicted, a natural rise occurred and I made 14.4 pips from this trade. Now for Wednesday's forecast. On Wednesday, we saw the US release their PPI figures. PPI meaning Producer Price Index, which measures the average change in selling prices received by domestic producers of goods and services over a period of time. PPI is a leading indicator of consumer inflation, as when producers charge more for goods and services, the higher costs are usually passed on to the consumer. This is therefore very important for traders. As the actual figure was better than the forecast, 0.1% and minus 0.2% respectively, this indicates to traders that they should go long.
So as Dominique said, traders would usually go long based on that news announcement. But what we decided to do was to go short a couple minutes prior to the news announcement at around 13.23 at a price of 1.11293. Based on the forecast, there was an expected decline, which I hedged my bets on. As expected, the forecast was correct and prices started falling, to which I banked my pips at 5.4. Of course, this was made right on the time the announcement was made, and of course the drop was quite sharp and it continued to decline, as you can see from the graph. Soon after the drop, the RSI threshold of 30 was being approached, indicating that a lot was being oversold. So 6 minutes after my short, I went long at a price of 1.11230. It did continue to drop, as you can see clearly on the graph, and it hit the threshold right there. Not at the bottom, but yeah. So I made another order, put profit order of 1.11295, and closed it 16 minutes later for 6.5 pips. So on Thursday, the unemployment claims were released from the US on Thursday, 18th of February at 1:30 p.m. And it looks at the number of individuals that have filed for unemployment insurance for the first time during the past week. So why is this important for traders? Well, although it's generally viewed as a lagging indicator, the number of unemployed people is an important signal of overall economic health, as consumer spending is highly correlated with the labor market. Now Dominique will go on to commenting on our trades that's been done for that day.
So with the news release at 1:30 p.m, we saw that the actual number was better than the forecasted amount at 269k. Traders expected an increase in price. After the initial lag, movement was seen in the market at 2:30 p.m, and this is where long orders were placed at the price of 1.1078. As you can see, the RSI indicates the currency was being oversold, therefore giving a buy signal. Sure enough, with the continued upward trend momentum of the RSI, orders was closed at 3.53 at a price of 1.1096 and 18 pips profit was made on this day. And for our last trade of the week, on Friday the 19th of February at 1:30, the US released figures on their CPI and core CPI. CPI is a change in the price of goods and services purchased by consumers. Core CPI is the change in the price of goods and services purchased by consumers, excluding food and energy. However, this indicator is much more volatile. This is important for traders as consumer prices account for a majority of overall inflation. Inflation is important to currency valuation because rising prices lead the central bank to raise interest rates out of respect for their inflation.
Thank you very much for that, Dominique. Now, going on to our own trades for what we did on that particular day. So as usual, we used the 15-minute graph and decided to go long on the pair at 13.45 for a price of 1.1080. The US news was released at 13.30, showing that the release of the new CPI figures and core CPI figures. The actual figure was better than the forecast, which was 0.0%, and the actual forecast was 0.3%. This means that it would be better to buy the currency. The RSI had also hit the 30 threshold and was at the point to gain momentum in an upward direction. The aim was to make 25 pips. But after the order began to lose momentum, as you can see through the MACD line, it hit the signal line in the downward direction, so I closed it at 1407, making only around 18 pips. I closed it at 1.1098.
So that concludes our trading roundup for this week.
Just remember, guys, never to trade based on predictions, or you'll be like Dominique here, who will make losses every Friday. Thank you for having us. This is Tausif,
This is Dominique.
and make sure you trade every Wednesday.
Have a really good weekend, folks.
Right, guys, so it's been a long break, long holiday. I hope you guys had a good vacation. One of our more prominent trading members, Felicia, will now come in and talk about her opinions and the overview of what we've been doing the past few weeks. Woo!
Hello. So, I wanted to say that Tassif here taught us a lot today. He's a wonderful professor at the University of Greenwich, and he's one of the best traders in this university. So we'd really like to thank him for what he taught us today. So I'm going to be doing the overview. And I want to say that setting up an Oanda account for practice enhances our skills for trading in any concept, such as working in business markets in the future. Essentially, we registered into the account, and each one of us created their own Oanda trading site. We were all given 100,000 grands to begin our trading. It takes quite some time to get in touch on how the system works and to consistently not lose the money. Therefore, the practice week we were trading gold, silver, UK 100, Japan yen. Yet for the practice and assessment week, we needed to focus only in terms of euros, USD, which was the hardest element in Oanda to gain profit. Thoughts are that it was more bit difficult because the difference, especially in the beginning, was only like 0.01 pence or 0.2, and lots of times we made a loss. Understanding the trade line and the RSI, which Tassif explained, assisted us on viewing the lowest points of the euro against the US dollar in order to buy units. So when the trade line would go up, we would make a profit, also called pips. Vice versa, in order to sell, we had to view most of the day and predict that the highest point of the trend line, where there is going to be a start to be a decline. Hence, we look at the currency rates in total, for example, 1.10853 USD to lower to 1.10852 USD, stating that there might be a drop in the next minute, then we know when to sell the units. In the end, we took screenshots to prove our work, our losses of profits, and also used the trading log for each movement transaction, as you saw previously.
Right now, guys, I'm going to talk about the 10 trades that were made. When the trades that were made, even with the losses, we typed down our results on a daily basis. We made sure that in the assessed trading week on Excel, we highlighted the gains and the losses and the cumulative frequency by the end of the week. To review our success or what went wrong to get better recommendations for future purposes. Not to forget to mention Oanda is a real trading site. So one could actually use this for real money, and we would not like to have a loss as it would damage his or her lifestyle. Concluding, I would say that the individual should know how to deal with such websites and to be careful to predict adequately according to the day, news around the world and the outlook of the market.
Overall, it was an entertaining, educating experience that took time, effort, and engagement to accomplish, which we optimistically wish to have done. We hope we made our point across on what trading simulation is about. Thank you very much for your time and commitment.
We hope you enjoyed our presentation.
Thank you for listening.
Goodbye and keep trading.
Have a great day.
Thank you, Massimo.